Crude oil is back to $72 per barrel, near pre-war levels. For India, this matters more than most countries. Let me explain why. When crude spiked during the war, India made a deliberate choice. Unlike many countries where fuel prices rose 25 to 60%, India kept retail prices largely stable. Petrol and diesel at public sector pumps barely moved. The oil companies, Indian Oil, BPCL, HPCL, absorbed the differences themselves. They were selling petrol at rupees 14 below cost and diesel at nearly rupees 25 below cost, accumulating losses with every liter sold. Now that crude has fallen, those companies are first recovering those accumulated losses before passing any benefit to consumers. That is why your petrol prices has not moved enough, even though crude has. Here is what has actually come down. Commercial LPG was cut by rupees 183 from July 1. Naira Energy, a private fuel retailer, cut petrol by rupees 5 per litre and diesel by rupees 3 per litre. Businesses are getting relief, but households are still waiting. One honest caveat: the war is not fully over. A fresh escalation could spike crude again. The current normalization may not hold if wars start again. For investors, crude normalizing matters more than the pump price. Lower crude means lower inflation, a clearer path for RBI rate cuts, and less pressure on the rupee. For equity investors who stayed through the war volatility, the macro environment is quietly becoming more supportive. Happy investing.